Investors are setting their sights on the Securities and Exchange Commission's highly anticipated report on the flash crash. Mary Shapiro tells me that report will be out within a week. She told me in an interview last night she hopes the report will be released as soon as possible. In a week is her expectation. In addition to that, she also talked in detail about one controversial issue facing investors today.
High-frequency trading clearly is an issue. It's 50 to 70% of the volume in our marketplace today. So for us to not be focused on high-frequency trading and its impact on investors and the capital-raising function would be crazy. I mean, we have to be focused on that and what kind of strategies they're employing.
So are they liquidity providers, and did they take part in strategies that destabilize the market? Joining me now to talk about that and the impact of high-frequency trading on market liquidity and profitability, my guest host, Strategy Sessions' Gary Kaminsky, along with Sal Arnuk, co-founder and partner at Themis Trading. Good to see you, Sal. Thanks so much for joining us.
Thank you, Maria. Glad to be here.
What do you think the Securities and Exchange Commission needs to address in that flash crash report?
Well, we put out a note earlier this week, and I think that we can see them bolstering the circuit breakers that they already have in place with a kind of limit up, limit down collar that we see in the futures markets. We can also expect to see them increasing market maker obligations in terms of the percentage of time they have to quote at the inside NBBO and how many levels of depth. There are a few things like that we expect the SEC to focus on. The elimination of stub quotes is another thing, but there are some things that are more difficult for the SEC to do and some things that we wish that they would do, and it'll be real interesting to see if that makes it into the report.
You know, Sal, a number of people think that if we didn't have what we had happen in May, none of this would have even ever been investigated. So why is it even relevant or important to investors that this report come out and that the study even take place? How is it going to affect things going forward?
Well, I think clearly May 6th was a defining day in our market structure's history. And if you look at the ICI's data, that 20 weeks in a row we've seen the equity investors, the individual investors, the retail, the 401k money flee the market. Clearly there's an issue of confidence. And it's not only related to what the government is doing on a largely economic basis. What are they going to do with taxes? What we may have heard your guest Peter Bookvart talk about earlier. It's also in the actual structure. Are they getting a fair shake when they trade in this marketplace? And they're clearly, this is not the same stock exchange, the same marketplace that was 3 years ago, which was 5 years ago, which was 10 years ago.
But those trends, those outflows in equity funds, those trends were in place way before May 6th. And so, as you correctly pointed out, that just exacerbated the problem. Is any report coming out of the SEC going to change that directional movement, which, as you say, has been going on for some time?
Well, I think that if you talk to people, if you talk to them at cocktail parties, if you read the blogs, if you read the internet, if you read the papers, people are concerned that the market is catering to the average person, not just the most speedy. And when they feel that the market is a tiered marketplace where one group of investors or participants can travel at one speed because they pay millions of dollars in co-location to exchanges versus everyone else, they have issues with that.
I just wonder, though, if we've given up, we've sacrificed too much in the effort towards speed and toward competition. You know, Mary Shapiro in a few minutes is going to come on the program. She's going to talk to us about how many electronic exchanges there are, how many other exchanges there are. I believe there's 11 exchanges. There's another 22 electronics. The time of a trade is a microsecond. Do we really need it to be a quarter of a second in order to get the trade executed? Are we giving something up, sacrificing something by all of this rushing toward speed and competition?
Maria, you framed that issue perfectly. There are now 11 or 12 separate exchanges. There are 40 some odd ATSs or dark pools. If you look at where an order goes today, once it leaves an investor's hands, there's a really insane web that the order can transfer through. Order routers. The order routers have an incentive to go to destination A first and destination B second. There's all types of conflicts of interest in the system, and the speed. I mean, clearly, look at PGN, Progress Energy, yesterday.
Right.
New York Stock Exchange, 5 microseconds, 5 1,000ths of a second. 5 milliseconds, 5 1,000ths of a second is all it took for the New York Stock Exchange to put its halt in place, and yet in those 5, milliseconds, look how many trades went off all the way down to $4.
Yeah. No wonder the individual has been missing in action. Thank you so much, Sal. Good to have you on the program. We appreciate it.
Thank you, Maria.
We will talk to you soon. Meanwhile, later.